going on, guys? Broke Investor here. Decided to make a quick video about chasing yield and why you should not go down that road. Typically, as new investors get involved and look for dividends, they're going to look for the cheaper stocks that pay the higher yield because, it's more attractive. They're going to make more money up front, so they think that's the route to go. So I wanted to make a video to talk about that and why that could come back to bite you later down the road. You need to think about long term versus the short term benefits. So let's take a look at two examples here. I'm sorry about the board. It may be too small to read, but I'll go through it and hopefully you guys will get the point. So there'll be two examples here. One is just no particular stock, just talking about, how much you'd have to put in to earn the same amount of money, chasing yield versus not. And this other one is actually two stock examples. So here we go. So if we look at this first row here, actually real quick, we're starting years 2019 and I'm going over a 20-year horizon. So every 5 years you'll see, the changes and how it results. So today, if you wanted to earn $1 in dividends, you can get that by buying into a stock that yields 8%. And you'd only have to pay $12.50 for that stock. So you pay $12.50, you get $1 in dividends for that year. Or, again, this stock could be more risky. Or you could pay more money, pay $50 to get that same dollar because you're only yielding 2%. So why would you do that, right? Why wouldn't you just spend $12.50 and get the dollar right away because you're already yielding 8% versus having to yield 2%, pay $50. So here's the idea. The stocks that are typically yielding 8%, those are not the stocks that are increasing their dividend year over year over year over year. So in this example, I'm just showing you, I gave a 0% increase year over year on this one. So 20 years later, you'll still be earning that same dollar. You'll have $12.50 capital gain. $12.50 in capital, assuming it didn't go down, which obviously it could have, or it could have gone up. In 2038, you'll be earning still $1 because the company that you invested in is not increasing their dividend, but they're still yielding 8%, which is pretty damn good, assuming that they can maintain that. So just keep in mind, you're investing, if you're investing in something like this, it's probably a real estate investment trust or it's just a high risk, some type of fund that, might not be worth it. In this example, this could be a blue chip stock, high, low yield, low starting yield, and in this example, I gave 10% increase year over year. So again, the first example, there's no increase year over year, and obviously you're making the same money 20 years later. In this example, there's your starting yield is 2%, but it's going up 10% year over year. So in 2019, you're paying $50 to get $1. However, 5 years later, you're getting $1.46. 5 years later, $2.36. Another 5 years, $3.80. 20 years later, $6.12. So for that same $50, you're actually, 6 times your money plus in dividends. Obviously, the key here is yield on cost. Your original investment, you're only making 2%, but when all said and done, 20 years later, your yield on cost is 12.23%. That's pretty damn solid. That beats the 8% that you would be getting still, again, assuming they can still afford that. So, and the other plus you got to think about here is the capital. Typically, companies like this, you could probably have in 20 years 500% gains in capital. This could be, who knows, like I said, a decrease. Who knows? But again, as a dividend investor, you typically don't care about capital, but it's nice to see. That's a good sign that the company's growing. So, long story short, if you take the shortcut, you take the high yield, it doesn't always pay off. Obviously, this could have gone a lot worse than this example, because you're still getting 8% year over year. That's good. I'd take it. But here, you're doing even better. So again, this is a best case scenario when you're taking the high risk, and this is a typical normal case of a blue chip stock. Now let's look at two actual live examples of two stocks, one sexy, one not so sexy. So the first chart here talks about CLM, Cornerstone Mutual. This is a closed-end fund, very complicated stock, but people know about this one because why? Their starting yield is 20% right now. Actually, it's over 20%. This chart here will talk about 3M, ticker symbol MMM. Not so sexy. Their starting yield is 3.22%. However, that's great on a blue chip stock. So typically it's around 2%, but in this example, the market's down right now, so we're sitting pretty. This is starting yield of 3% on a blue chip stock. But when you look at that 3% versus 20%, wow, what a difference, right? So I looked at these two stocks, and I looked at the dividends over the past 5 years. Wrote it down over here. So CLM, right now, they pay monthly, and their dividend is 0.2053%. So basically 20 cents per month in dividends. However, in 2015, same monthly dividend, they were paying 0.368 per month. So 36, round up 37 cents. That's a decrease of 44% within 5 years. I mean, that's not good. So if you average that out over 5 years, it's around a decrease of 8.84%, which I used in this example. So if you look, the dividend, today you're only spending $12 in the stock, and you're getting $2.46 a year. That's pretty freaking solid, right? So, but the decrease, based on the annual decrease of around 8%, in 5 years, you're only going to make $1.70 on your same money. Your yield on cost is going down 13%. 5 years later, only $1.07. Yield on cost 8.75%. 5 years later, 67 cents. Another 5 years, 42 cents. Same money, now you're only making 42 cents a year. I mean, that sucks. Your yield on cost is now down to 3%. So this, 3%, again, it's still not bad, but this is assuming the stock's still around. They didn't get rid of their dividend, but this is just averaging out a decrease of 8% year over year, which, it sucks. So, because you went from 20% yield to 3% yield. You don't want to go down. You don't want your income, these dividends are your income. You don't want your income to go down. That's like taking a pay cut. That's like admittedly taking a pay cut of 8% year over year. No one would do that. So why would you put your money into something that would do that? So obviously, yeah, long story short, it's very sexy to buy it now. You're getting 20% on your money. But if you look over long term, that 20% right down to 3% in 20 years. That sucks. That's not good. Plus, stocks like this is a closed-end fund. In order to pay these high yields, typically they take some from capital. So you got to keep an eye on that. I know this is not what this video is about, but I just wanted to throw that in there. So, although they're paying you 20%, some of that's your own money because they're chipping that off the capital. And the capital, that's what you're paying. So some of it is your own money. But regardless, it's not sustainable. So don't be chasing yield again. So that was a high risk chase yield option. Let's look at 3M, okay? So 3M is $178 per share now. Obviously, people look at that and be like, phew, especially new investors, I can't afford that. That's not worth it. So I'm paying $178 to make $5.76 a year in dividends. Again, starting yield is 3.22%. So I looked at 3M's. They pay quarterly. Their quarterly dividend this year is $1.44, and their quarterly dividend in 2015 was $1.02. So that's a 40.49% increase for the 5 years divided by 5. It's an average annual increase of 8.1%. So I use that in this example, obviously. So first year, yeah, you'll be making $5.76 on that money. Second year, you'll be making $7.86. Obviously, your yield on cost is going up. So on and so forth. You get the hint, but we go down 20 years from today, you're going to be making $25.29 for each share that you own. Yield on cost, 14.14%. Where are you going to get that? I mean, and again, it's only going to continue to go up. I mean, companies like this have been raising, 3M, been raising their dividend forever. I mean, it's longer than most of you most of you have been born. Probably 2 of you combined have been born. So they're a dividend king. So anyway, as you can see, 3M taking the average dividend increase of 8.1%, your yield on cost is just going to continue to go up. Is it worth it to pay the higher amount for a stock for a lower yield? Yes. If the company's 3M, or if the company's a blue chip stock that can survive all market crashes, all downward trends, all this and that and the other thing. So yes, I mean, CLM, again, this is a stock that's paying a hefty yield right now. 3M, again, it's not as attractive, but it's a smart way to do it if you look at the long term. You need to look at things long term versus short term. If you can make up money on this short term, flip it, sell it, still make a profit, fine, so be it. But that's a risky game to play. So anyway, I wanted to make this video hopefully short and sweet. I'm already on 12 minutes, but don't chase yield. If you're a new investor and you have no money, do not chase yield. If you cannot afford companies like 3M, then wait until you can put more money in, and then you buy it. Or there's other stocks. 3M's, it's more expensive than, like, say Coca-Cola or Starbucks, companies like that. But just as soon as you look at a company and you see a 20% yield, 15% yield, just be wary. That is unsustainable. Nobody can really continue to pay that amount unless they're taking it from your capital, or I don't know. That's really unrealistic. In this example, this is more realistic. An 8%. REITs. Some REITs can do that, especially now when the market's down. So again, I wanted to make this video mainly for new investors who think that chasing yield is a wise option. Obviously, it's not, and I'm assuming if you're a new investor, you're not that old either. So you do have 20 years, and 20 years does matter to you. So when you're buying stocks, assuming you're holding them for long term, these are the implications. So you need to check the history. This is important stuff. So again, hopefully you guys learned a thing or two about this video. Hopefully you can see the board. If not, I apologize, but hopefully I explained it pretty well. And again, do not chase yield. Again, okay? Just take a look at history. Companies like 3M will reward you, and 3M doesn't. 8.1% is not even. There's companies paying a lot more than that per year. So, but I wanted to give just a plain example, nothing too aggressive. All right. Hope you enjoyed the video. Leave a comment. Any questions? Leave them comment down below. Click like, share it with your friends, tell your friends, all right? Later.